There we go. We started up. We have our fun today. We've got a special guest, Bernie Johnson, for giving some tax advice. So what we're going to do is take questions, and then we're also going to go through some of the basics, like deductions, searching for deductions, what is a deduction that you can use in real estate, and where to report that. So, Dad, what's your background? What value do you have in this?
Well, yeah, my background is I started doing taxes back in the 80s, and I've been doing taxes for over 41 years. Originally, I worked for a small accounting firm, then I worked for what was then called the Big 8 accounting firm, Deloitte Haskins and Sells. And then I went to a smaller firm in San Antonio and focused primarily on tax work. And then I started my own practice here out of this office building in 1988, I believe it was, when I shifted from another business to this. And since then I've been doing the tax returns for Don Johnson Company, and I had my own personal tax practice until I acquired the company from my parents in 1994. When they wanted to get out of the business.
And you've done an unholy amount of taxes.
I've done a lot of taxes. I've done a lot of taxes, and I've done taxes for some interesting things.
But let me start with this. So I think the most common thing, I went and I polled some agents yesterday, and one of the biggest things that people had questions on, and funny enough you start with on, is, okay, deductions. What are things, can you kind of cover some of the things people should be tracking as far as deductions as agents?
Yeah, well, first off, at minimum, be a shoebox a month. Mm-hmm. And by that I mean, anytime you buy something, you put the receipt that may have any relationship to being real estate, you put it in a shoebox for summarization later on. Now, if you want to pay a lot of money, bring the shoebox to your accountant and let them sort it out. If you want to pay less money, you sort through it based on the various categories of expenses that would be on your last tax return, if you've already had one done. And then you'll save some money doing that. I want to share right off the bat, over the years, and I've done a lot of tax work in the past for this type of profession, similar, there's a tendency to overstate your expenses. And all I can tell you is just make sure that your intentions aren't construed as being dishonest. Because I've literally had a 75-year-old woman that was going to federal court for tax fraud. Mm-hmm. And it's a funny feeling talking to the son of someone of that age, dealing with something that you would think, well, this is not going to happen to grandma. Well, it can happen to anybody. And being dishonest, and faking your deductions is not going to get it done. Where you asked, where the big deductions that you need to really be careful of to keep track of, meals and entertainment,
okay,
auto use, mileage.
What are the qualifications like on meals and entertainment? Just you're taking someone out for a meal, for like coffee, to talk business with them?
I can't think I'd find any meal that I wouldn't turn into a business meal.
Discussion.
Because all I have to do is turn it into a business discussion. Now, I've gone through a number of audits with people in the past dealing with this, and I can tell you what's worked for them. If you've done nothing more than keep a calendar, like a daily planner, Johnson, 32 miles, so on, that day. Contemporaneous recording the miles, and then it would be showing houses.
And what you did, yeah.
You don't have to, I didn't, I can just tell you what I did. I've gone through several audits like that. It's perfectly fine. They're so happy. The auditors are so happy if you have anything. Because most of the people when they come are so poorly prepared that they're happy when they actually have someone that has the information they need. So what you want to make sure of is you keep track of it. You can put it in a shoebox. Better yet, if you have a program like QuickBooks or something like that, that would be a useful tool for keeping track of your expenses. I would say my best advice of all would be use one credit card for business owners.
Yes. Oh my God. Yes, that's
for anything that could be related to business.
Yeah.
Anything you might remotely think is connected to business, put on there. You can sort through it later to see if it's not. But let's get everything in there that could be.
Give your statement.
Because I can tell you that the vast majority of people actually overpay their taxes.
Yeah.
Overpay. Because they have what they use the shoebox thing. But I got to ask you the question. What direction is the error going to be if you have all your expenses in a shoebox? What direction? Is it going to be overstated or understated?
Under.
Yeah, fine. Because you forgot something. You missed something. You had one that you didn't see, or you were going so quickly you didn't write it down, or you wrote the wrong number down. You wrote $29.95 and it's $299.50. All the time it happens like that. Very typically, I have seen people way overstate their taxes by virtue of, in a business like this, by virtue of not keeping track of their expenses.
Okay, you have a good list of some stuff on here that people should be tracking. Maybe we should start with something different. What cannot be written off? Your initial licensing cannot be written off.
The training
for new agents.
The training to become a real estate agent is not deductible. Just like if you got a degree in accounting or whatever it may be, they're not going to let you deduct your college education. They're just not going to let that happen. So the training to become a CPA is not covered. But once you become one, all the continuing education, anything you're doing to become advanced certification, that's a different story. Once you're licensed, everything you pay becomes a part of what you can deduct from.
So your continuing education that you take as an agent is a write-off. Your MLS board fees and such, everything associated with that is a write-off.
Right here, I have
a
a bunch of pages. I've got about 10 copies here that if people want one, you're welcome to make a copy downstairs. I'll leave them at the front desk if they want it.
Oh, that's nice.
And you can use that. And if you have questions, you can always get with me. And by the way, no, I'm not doing anyone's taxes. I'm doing my own.
Here's $1 million.
And your
For
son.
$1 million, I'll do your taxes. But as you can see, some of the things, your MLS fees, association dues, license fees and renewals, commissions received and paid to other realtors or staff, marketing and advertising costs, any independent contractor costs, office supplies and equipment. Okay, so I would say that virtually any time I go to the office store, virtually anything I buy, it's paper, pencil, pen, to me that would be, unless it's crayons, I would consider that expensive.
You might be coloring a poster for your list.
You might, and if that's the case, then you write down what it's for. Why cheat yourself? Client gifts are a part of that. And I'm not sure that number's good anymore. It might be $50 now.
It's $50 now for client gifts.
I'm sorry, I wrote this up originally, and Brad reminded me I didn't proof it well enough.
Real quick on the uniform expense, that includes conversions of clothing to, if you get, okay, Brian Skelton.
It has to be specialized. It has to be specialized.
Embroidered imagery, like the company emblem or the Berkshire Hathaway, the circle and such. That now is a write-off.
If you buy a shirt with your advertising on it, that's obviously good.
But not a brand new Calvin Klein suit.
No, not the suit, but if you had a shirt with an emblem on it, yes, or add an emblem to a shirt, you're converting it to business use, then you could write it off. So, not.
What if you put the word your emblem on your suit?
On that item, yes, is my understanding.
Why not? Look, that's small. I mean, if you're writing off $10,000 worth of apparel with business, saying that it's you're going to have a problem. Well, it's not going to be there. You might have $300, $400, $500 a year that you spend on stuff that you have embroidered or whatever, and that of course is going to be deductible.
Isn't the IRS kind of, because you put your industry code in when you do your taxes, they kind of know what the average.
Well, they know. Here's what they know. They know where the people cheat. Yeah. And the big cheating is going to be on meals and entertainment, and travel stuff like they're going to fake it. So you'll see someone trying to get away with 100% auto use. I'm sorry, if you claim 100% auto use in your vehicle, you're aiming to get audited. You might get away with it if you bought it on day 365 and used it 100% for business that day, and you say, okay, I'm 100% business, but it's not going to be that. In this business here, I think if you're looking, I've seen 60 to 80% is a number that I've seen on tax returns that have been accepted and not been a problem. As far as business use.
Real quick on that. So, okay.
But let me
go ahead.
It's not easy to keep track. What I would recommend to people is if you're not good at it, you can track it for a few months. Track it for 2 or 3 months, and then determine your business percentage. Because your business percentage is going to help you determine what part of that cost you can deduct. For example, if I am half business and half real and not half personal, and I buy $10 worth of gasoline, how much is going to be deductible? $5. If I'm 70%, $7. So you can see that difference can add up over time. If you buy $3,000 worth of gasoline in a year, or whatever it may be, and it's half deductible, it's $1,500 versus 70%, that's $20, that's $600 you save by just that simple little thing. But what you do is you track your business miles for 3 months or 2 months, whatever it may be, and then from that you extrapolate or compute what your business percentage is. So you keep track of your total miles and your business miles. Now here's your question. What's a business mile? And that's a great question. Commuting to and from the office is not a business mile. But if I go from my house to that listing over here, well, I drove to a listing first. That's business. Oh, now I drove from a listing to my office. Well, now that's deductible because I'm not commuting to my home, from my home. See the difference?
The normal day-to-day commute cannot be
Your
written off.
if you're an employee, they're not going to let you deduct going back, driving to and from the office. But in our business, if you structure your business intelligently, you can basically turn your day. I think you can get yourself to 75-80% business use if you have another car in the house if it's a family. Now, I think you can do that.
And you have 2 cars there.
Yeah, I think so.
Any questions on this, ladies?
That's what we do.
Yeah, so is this considered my office?
Yes.
Okay.
Or any of the physical okay, here's some ways that my brother and I work with that. I would go deliver cards to coffee shops and such. I would document that. And to start, if I was really trying to min-max my mileage for when I was doing my sampling, I would document that, putting the card, taking the photo and stuff like that at that coffee place. Now I'm dropping that off now that I commute to the office.
But going from your home to a sales meeting to your home is not deductible.
Bingo.
Okay.
That's just how it is.
Call it something else.
But going
Call
to
the show.
a listing and then going back home, is that?
Yes.
Okay.
That's business. Yeah.
Okay.
Sure. So keep in mind this thing, if you get it, some of these numbers were generated a few years ago. So like the business miles, cents per mile is no longer an accurate number.
Yeah.
It's really not important. The idea, it's the concept that you really need to be looking for because these are the things. I can't stress enough. You can get your taxes done pretty cheap. Not that expensive.
Yeah.
I would highly recommend you organize yourself as best you can with the information that you learned here and take it to a tax professional. And for a few $100s, they can get the thing done and you'll be more confident about getting it done correctly. That's what I would recommend.
And a lot of the programs have become pretty easy to work with for
I use TurboTax.
TurboTax, yeah.
But I use TurboTax self-employed.
Yeah.
About $300.
And that's good. But there's a saying with computers, garbage in, garbage out. And if you put the wrong information, you're going to get the wrong information out. And if you don't put enough in, you're going to get an incorrect return anyway, but it'll look real pretty.
And it's not bad. I don't think it's a bad practice to start getting a CPA, at least at the beginning. To
Yeah,
go
and
over
learn
this.
what they know, and then let it. That's what I did.
Yeah, like what Jeff did. Not a bad thing to do.
Well, I'm sorry, can you repeat that?
Start with a CPA for a year or two.
If
And if you're feeling confident, because, all right, I will say this part. It's not super complicated, the write-offs. Once you see where you're putting it there.
Who does your taxes?
Yeah, I could do it if I had to. But you've got a really good program.
He's giving you, okay.
That's
That's
gonna
true.
take
I have a
you
really
It's
good
like you
one.
call a repairman out
I
to your
have-
house to fix
I would-
something,
I-
you learn how to do it while he's there, and then you never call him out again, and it's better.
Okay, got it.
TurboTax is really good.
May I ask you a question? Are all realtors created equal?
No.
Are all tax people created equal?
No.
Yes.
Is H&R Block equal to a CPA firm?
No.
No, it's not. Okay. I'm just telling you.
Okay,
CPAs are
expenses, home office expense. Let's talk on that.
Okay. If you have a room specifically set up as an office, and that's it, a office, you can introduce this. Now, what does that mean? Let's say I have 1,000 square foot home. Every entrance is from the outside, and there's no common area walkways, and no bathrooms, and no nothing. And it's 1,000 square feet, and I have a 100 square foot office.
Okay.
1/10 of the expenses of that home
Okay.
are going
What kind of
to be
expenses,
deductible,
man?
and they are going to be your interest expense on your home, the
Okay.
taxes you paid on your property taxes you pay, the repair expenses you pay, all that stuff, all
Utilities?
that. Now here, but if that repair expense is, for example, on fixing your color TV or the living room, no, I'm sorry, that's not part of it.
But it's my lobby for clients.
Well, keep in mind, we've never said, in our example, it was an outside entrance for everything. So you couldn't come up.
But-
in reality is, what you're gonna do is you're gonna take the common areas, the walkways and such, and you're gonna help determine your percentage by cutting that out. So if you sit there and have a 100 square foot office, same 1,000 square foot home, and you have 100 square feet of walkway, well, that walkway serves many things. What if it only served your office? What if that walkway only served your office? Well, then that's 200 square feet that you're going to use.
Right.
But let's say that walkway served the whole home, including yours. So now you're going to sit there and subtract 100 feet from the 1,000 feet because that's common area. And now your percentage is 100 divided by what? Your 100 square foot office divided by your 1,000 square foot home less the common area of 100 square feet. Remember the walkway? So your business portion is now 100 square feet divided by 900 square feet, or 1/9.
Okay, the gross, you net out of the total square footage when
Common
you
area.
get the percentage common area.
Okay, first you take out the 100 square
You
foot.
set aside your 100,
Okay, now,
and
then
instead
you
of
take out-
instead of 1,000, out of 1,000, it'd be out of 900.
Okay.
okay, but what about that bathroom? Doesn't your client use the bathroom when he comes and visits?
No.
Sure they do.
I
It's,
don't.
it's available to them. Oh, so that 100 square foot bathroom that's in that same offer, that's also an area of common area.
100 square foot bathroom.
So now we have 200 square feet of common area and 200 square feet, your 100 foot office, and 800 feet that's actual, right? So 100 divided by 800 now becomes 0.125.
What about the little
Well,
section of your
1.5%.
garage that you use to store your signs?
No, you do what you want. I'm just telling you.
Jeff is a
You're
very
gonna
aggressive.
You're gonna figure out your common area, and you're gonna come up with a calculation, and they'll be happy. I don't think you're gonna have a problem if you do it. It's when you don't do it. If you ever get audited, it's the stuff you don't do that's gonna create a problem.
I do it for home office. I do it the easy way.
And let me tell you, going through audit before
Square footage times $5.
Yeah.
it's if you ever go through an audit and you go to and you're in that general room with all these other little cubicles and you can hear what's going on. They love targeting the people that are not represented. They love finding people that don't have someone there to help them.
Yes.
Because our joke when we went through college in accounting was the A students went to work for the big 8 accounting firms, the B students went to work for corporate, and the C and D students went to work for the IRS. That was the joke that we had running. But the point being, they were a little fearful because typically the accountants that were working there had strived to be an accountant, CPA or whatever. They didn't get there, and so they're a little worried that you're going to show them up. That's what my experience was. They're a little worried that you're going to make them look stupid in front of other people because your level of knowledge is going to be so much more than theirs. Because and I'm serious, it's the truth. I mean, when you've been doing this stuff for something 40 or 50 years, you're going to know more than someone that's been working for a year.
They're not going to bully you.
Yeah, they don't. And they try to bully the other people, by the way. I saw that.
Travel expenses, Dad. Well, kind of relevant to our last
Oh, my
meeting we're
goodness.
talking
We have a
about.
big travel expense coming up right now. I used to go to this is my first year not going to the convention, by the way. And it's deductible. It's your business convention. So you go there, your whole trip's deductible. Now, not your presents and stuff that you buy people. Unless it's a
Meals,
business expense.
Yeah, you buy me a shirt.
Meals.
travel
Entertainment,
expense,
travel.
lodging.
Again, pretty much everything associated with the trip is going to be deductible.
Yeah.
Are meals 100%?
Where? Schedule C. Schedule C.
Are meals 100%?
No. Well,
Business
you're
trips.
keeping track of them at 100%, but it's going to on your return it's going to turn it to 50.
Okay.
So keep that in mind. But that's very interesting because you can turn that from a 50% to 100% if it's a presentation expense.
I learned all about that through you.
Presentation expense.
I never.
If I sat there and say I'm going to present this, well, that's no longer a meal. That becomes presentation expense and not a meals and entertainment.
What do you present? You could present a CMA.
The 6-month market report. You present that to someone I used to do this, I still do
I
this.
present CMAs to Hector all the time.
You don't classify, you don't go in there saying meals slash dinner, you go presentation expense. It's gonna be under other deductions, and if they ask about it, you explain, well, it's a presentation, it's not a meal entertainment, I'm not entertaining anyone here, and I'm not just having a meal with someone, I'm actually making a presentation. This is a specific business purpose. That's why you see these companies out there, that you'll see someone inviting someone to Chamagaucha. You think Almo Title, these people invite them and they're not gonna deduct it? If they take those people to Chamagaucha, that entire thing is deductible. Yeah, I guarantee you.
They're presenting their
So,
services.
it's all good. So, again, when in doubt, do what? Write it down and then ask your,
So real funny on that one. If you notice, Jessica will always tell you about the Alamo app when you go out to eat. I don't know if you're with that. And that's what she's making you, it's very funny. She's like, I want to tell you, Alamo app, we have these updates. I want to present these ideas. And she even uses the word, I want to present this to you. I sometimes wonder if she's recording it. But yeah.
Bernie, I got a question for you.
sure.
Jeff goes to Rome. Jeff sees a
God.
Berkshire Hathaway sign, walks in the office, says hi to the people, give them my business card, talk to them for about an hour or two about Roman real estate business. Alright, then Jeff goes to Florence, and he stops, and he sees a Berkshire Hathaway in Florence, and he stops in, and he does the same thing.
Mr.
He
Evans,
does that. He does it about 3 or 4 times.
Mr.
What can he write off?
tell us about your trip that you went on, Jeff. You went to Europe, I see here.
I did.
Did you go by yourself?
I brought Hector. He's also a real
business
estate
partner.
partner.
And and you had many stops, I assume?
Yes,
And did you do real estate while you were there?
I did. I went to this office, this office, this office. I had this business card,
Mm-hmm.
this business card from this person. We talked about this. I had this brand new listing I wanted to present to them, and I gave it to them.
Now, if I were the agent, I'd be laughing at this point.
I'm serious. I'm laughing because you're looking at me like that. But I'm not being so serious.
But again, you might have it could be something you'd have to explain, and it might be a problem. You might have a problem.
Okay. Would I write up 100%? Absolutely not. But would I do maybe 5%?
I would, if it were me, I would take a portion of that.
Mm-hmm.
But I think when you look at something like that, it should really start off with what was your plan in the first place. So if I were wanting to turn that into deduction, I'd be smart. A smart person, Jeff, would sit there and ahead of time make contact with each of these offices. Tell them I'm planning on coming there. I'm specifically looking for a client, looking for specific property in Europe.
Or vice versa, try to get one sold here.
I would,
Yeah.
no, that too. I would then find someone here that would be looking for that specific, for something in Europe, let's say, a client. And I'm gonna be looking for them, I'm gonna be hired by them to look for investment. I'm gonna have a buyer's rep agreement. I'm gonna be looking for properties here for foreign purchase. And there's a reason, and you come up with your explanations, you do it right, yes, it's deductible. If you do it right. But I would, even then, I'd probably take a partial. Because,
Yeah, no, never
but the
100%.
key here is what? To get any of it, I think you need to plan ahead. The idea of, I saw a Berkshire Hathaway sign while I was in Florence, and I called the office and said hi and tell me about it. Now
I Googled where it was before I left. Searched my history.
it doesn't quite work. But I appreciate the clever thought.
Well, I hear business people never go on vacations. They go on business trips.
Well, I mean, you put it on your website. I have connections within Rome, and then you.
There's even cruise ships that have training on them.
Okay, what if I go on a cruise ship and I make connections with people on the cruise ship and actually do a deal with them on the cruise
And
ship?
let me tell you what I would do. If I were doing that, I would contact them ahead of time and ask them
Well, I'm not going on the cruise.
what their are people able to deduct this? I would make a contact with the cruise company and say, is this, or the people that are arranging it, and ask them if it's deductible and get something in writing.
Yeah.
So what are you looking for? Now you're just looking for something authoritative. The one thing people like is authoritative. Well, yeah. So here's my authoritative proof that I asked ahead of time, and this is deductible.
Yeah, it's part of the planning.
According
for the
to
trip.
the planning for the trip, this is a special trip designed specifically for continuing education, so I can do a better job in real estate.
Yeah, they used to have that.
Here's my authorization form that it's tax deductible by XYZ.
Must have my flyers.
So,
Oh, sorry. Yeah.
sorry about it.
So you know what?
okay.
They used to have CE classes on a cruise ship out of Galveston that the Texas Realtors used to put on. And it was
By the way,
like 3 or
these
4
are great
days,
conversations with your CPA.
depending on how
Because
shit
if you're getting into stuff like this, then you're getting into serious stuff.
I have a question. Sorry.
Go. No, stop us, please.
Okay, so my husband has a business and I'm starting a business, so how do I deduct it? It's still...
You'll have your own Schedule C. It's going to be, you're going to have your own form. It should be on the very, did I make a copy of it or not?
You did.
I should have a, look at the back.
Grab your.
I think I thought I made it.
Oh, it's on that one. Yeah, look at the back. This is Schedule C in there.
I think there's one back.
Okay, got it. Here, I see it. It's here.
Yes.
So that's, quickly looking at the forms in the back, let's go take a look at these. Because
Profit and loss business.
I obviously first you have your front page, Schedule 1040. And I'm assuming that's what y'all would be using. Your Schedule C is going to end up flowing to line 9. From Schedule C. Schedule C goes to another, it ends up adding into like a schedule that organizes all the various above what we call above the line deductions that are not already on that front page. An above the line deduction is an adjustment to arrive at adjusted gross income.
Which is good.
You know, you want to get, so you're getting down to adjusted gross income because a lot of calculations are going to be based on adjusted gross income or modified adjusted gross income. You know, some of the levels of deductions you can take for child care and a whole bunch of other things are limited based on if they think you're too rich, they're going to start phasing out some of the expenses that you can deduct. And typically, this is where you would see that, the phased out number.
Yeah, so my question here is, my husband uses one part of the house for his business, and I'm using another part of the house for the business. So
Are y'all not using the CPA?
what?
Y'all use the CPA?
He has a CPA, but it's
Well,
not
that's
for
easy.
real estate. He's trucking. So
But he's preparing your tax return.
yeah.
Well, if he's preparing the return, he's going to prepare your return too, because it's all.
No, we're filing jointly.
Unless you're filing separately.
No, we're not.
Yeah. If you're filing
Yeah.
jointly, then he should be the one, and you know, he's not going to sign off on anything that you discussed. Like if you were looking for specific tax advice or like the stuff I'm saying, this is the stuff you'd probably want to cover with them because not everyone shares the same, you know, level of aggressiveness. in
These are pretty basic things we're talking about, though. Under
Okay.
that, like, I mean, he should be putting.
Well,
he should be asking you.
I
this stuff.
know from my own experience that there's many different levels of degrees of risk that account. You know, there's a lot of accountants. You know, if you go to a big accounting firm and you're nobody, you're not getting. They're not going to give you any. You know, like, hey, do this, do that. You're going to get the basic stuff because they're not going to risk their license over doing something stupid. You know, deliberately.
Well, I mean, most of the stuff, Dad, vehicle expense and all these things is pretty. Meals and entertainment. I mean, as long as you're legitimate and you're tracking.
I literally sat in this office, and I think I sat up here across from a guy talking with him about how he cheated on his taxes. And you know, and I looked at what he did, and you know, when he said he was at audit and the auditor questioned him about something or other, you know, about his business use of something. And you can see that he had pulled up what he had done. He had falsified his business mileage. So he was going to claim, you know, he was. I don't even think he claimed the actual use. He claimed the mileage, but he was claiming like a ridiculous number. He was almost 190 or 100%. But of the total of the number that was really high. And what you don't know is that they can go, the IRS can go to an auto shop that's done the work, and they can actually get the information on what the mileage was on your vehicle. And by the way, if you look at the repair invoices from your vehicle, what do you can always find on there?
The mileage.
The mileage. The mileage is always on there because they use that to determine their liability or equity, how much they owe you if it doesn't cover 90 days or whatever their deal is with you. So he got caught.
Yeah.
He got caught, and it was not a good thing. And I think I think she felt sorry for him a little bit. I don't think he got in big trouble for it, but he
I'm
he
bad
could
at
have been.
that.
He could have been. He could have been. And it's very it's that's the kind of stuff that they catch. It's the
Well, they know what's normal.
Oh,
for a
they do.
different
They
industry.
actually have,
Yeah.
I can't remember the name, it's a discrete system that evaluates all the tax returns, and it looks for the proportionality of certain numbers like auto, meals and entertainment, so forth, and then your work code, like if you're a realtor or whatever it may be. And then it'll take that and compare that to industry standards. And if you're above, they don't give you the means by which they calculate, but clearly if you're above a certain number or below a certain number, they're going to be visiting with you about why that number is not what they expect.
That's what I love about TurboTax. I don't want to take any money away from your industry, but when you finish it, it goes by category, and you're either green, yellow, or red. Chances of getting audited. So I'm like, oh shit, I'm in the yellow. I need to get to the green. I need to take away some miles.
Yeah, TurboTax is a good program.
Ladies, questions. You have a CPA here. What would you like to know about?
I'm not a CPA. I used to be a
Okay, used to be a CPA. What would you like to know?
I don't even know what a CPA is.
certified public accountant.
A tax person.
Okay. Well, a CPA, a certified public accountant, their primary job is really not taxes.
Okay.
It's actually attesting to the financial statements of an organization. So an audit, a review, or a compilation are the three things that a CPA can do that no one else is allowed to do. You know, we can sign off. We can sign an audit is that we are attesting to those financial statements being materially correct. If they're not, so they haven't falsified their financial statements, which is very important. Why is that important? Because people take their financial statements to determine if they get loans and things like that. So they want to know that the people that they're dealing with have financial security. They count on CPAs to make sure, to assure them that the numbers they're looking at are more or less accurate so that they can rely on them. Same applies to a review, but to a lesser extent than an audit. An audit's a very high statement because we're basically saying we believe, we are attesting to those numbers being correct. And by that I meant within 5% accuracy of the total numbers. That's what we attest to. I don't, but that's what they do if they're actually doing that. You don't need to be a CPA to do tax returns. There's plenty of people that do tax returns. You can go to H&R Block and maybe some of them are, but there's very few.
There's plug in numbers.
Jackson, they plug in numbers and they do the stuff. What a CPA does is provides intellectual input to me. I mean, you really want to sit down with them, not about filling out forms and punching numbers. I can teach a monkey to punch in the number, but you want to sit down and visit with them about how you're going to plan your future with relation to the numbers and the taxes and how to sort of work through some of the things that you're dealing with. For example, if you have inheritance that might be coming up, you might have some planning that you'd be doing that would reflect what you're doing now in your life with what might be happening to you down the line. You might use that CPA as sort of a financial planner for you in a way. They can do that as well. You don't have to go to a financial planner. Your CPA can do all that stuff himself as well. They're very capable. They're more trained than a financial planner.
Yeah.
The first thing they're going to recommend you is to get an IRA Roth because it's tax deductible.
Yeah.
Questions
So-
on deductions and such.
Like when we file our taxes, I know like everybody's like, this is your business, Do you file under your name or do you get like an LLC? Do you file what do you do?
On that one.
Okay, yeah. But we're not going to, the vast majority of people are going to file it on their regular tax return.
Okay.
And there's a new schedule that you're going to have. If your spouse or whatever is not self-employed, you're going to add the Schedule C, which is, you'll see on the back there.
Okay.
Okay, the Schedule C is the one that's going to be filled out.
If you go to a CPA, they're going to talk you into starting an LLC.
And the numbers you're going to get from there, from the firm that you work with, like Don Johnson Company, you're going to get a 1099 that's going to show you the income that you made as an accountant. That number is going to go to your first line on that return, and then further down below are going to be the other income and expenses associated with that business. So, like that CPA, you're going to see under there professional fees or lawyer. That would be professional expenses. You're going to see, if you borrowed money to buy a computer or something, the interest expense on that. You're gonna take all the assets, the kind of stuff that you're converting to business use. I'll give you a great example of that. You just started your business, and we've converted this room to be this, and in that room is a $5,000 business couch. You bought it 5 years ago. It's $5,000. It's a great, great couch. It's going to be in there, but it's 5 years old. It's when it's placed in service. Anything can be, so that furniture and fixture was placed in service on the date you became, the date that became an office.
Yeah, put in use, yeah.
Yeah, and that's going to be spread out over 5 years at 125%. I mean, it's spread out. You're going to get a depreciation expense deduction off of that for a period of time. Now, if by the same token, let's say you started your business this year and you bought a brand new computer and furniture and fixture, and you spent $10,000 on equipment to furnish that office. That's depreciable. But guess what else? There's a thing called the Section 179 deduction, and you can deduct the whole thing.
Yep.
Right off the bat, first year. Again, pretty cool stuff.
179, you said?
Section 179 deduction. I think that's the one.
It
Yeah,
is.
that's right. Yeah, no. Yeah, the other one is the lifetime, 1030.
Let's not do,
179 is the business expense for writing on that.
we're not doing 1031.
1031 is the like-kind
The
exchange
what?
transaction.
Do TurboTax, you don't need no name forms.
Oh, okay.
Yeah.
Well, we don't do TurboTax, we go to somebody to do our tax.
Well, then you don't need no name.
Yeah, you're good.
They'll know it.
I just
Yeah.
didn't know what.
So
I
my
needed to know.
personal experience with taxes, I started out doing it myself. I had a spreadsheet. I was a shoebox accountant, and then once a quarter I'd put everything in a spreadsheet in the categories: advertising, utility, everything in categories. And then once a year, then I'd put it in like a TurboTax thing. Then I found an accountant, a CPA, and he charged a lot of money. He was not $200, Bernie. He was thousands of dollars because he talked me into creating an LLC because it would save me money because you don't have to pay self-employment taxes, right? But every dime I'd save from the IRS, I'd end up paying him, so it didn't save me any money. So I fired his ass, and I started doing it myself, TurboTax, and I pay $350 a year to do TurboTax, and it's the higher one. It's TurboTax self-employed with a live person I could ask questions to.
Time out. Stop.
Sorry.
Jeff? They're not Jeff Everett.
I know they're not.
Jeff Everett is a businessman that came into this thing, and he already had a huge amount of business experience.
This is true.
Running a business. It's
Yeah.
not the same thing.
This is true.
People come
But
in real-
beware
Okay.
of the CPA trying to sell you things
Okay.
you don't need.
You don't, and starting off as an agent, there's no reason, in my opinion, and my brother and I ran the numbers on it, to make an LLC for
The
yourself.
magic, okay, I'll tell you what, the magic number is $100,000 in income. That's when it is.
That's when it can start making sense.
Yeah, if you're making $100,000 of commissions, then maybe you might want to think about doing an LLC. But if you're under that, don't even worry about it.
Most people don't realize that first year in real estate, you're probably not going to.
You didn't even talk about corporate
Most people don't make honest to God. Now, I hope you make money your first year. I really do.
A profit.
But I would, but it's not uncommon for people to start, let's say mid-year or whatever. They start in the summer, and then, at the end of the year, once you tend to into your expenses and stuff, you didn't make any money.
Should throw away
The first year. So, I'm not usually too worried about getting hammered for unpaid, taxes. When you're supposed to estimate your tax bill each year if you're self-employed, and then make quarterly estimated payments, which is important to mention because
Very important.
on your on the 15th day of the 4th, 6th, 9th, and 12th month, which would be different. April,
April
June,
15th.
October, January.
June 15th.
In October and then January, you make your estimated tax payments, which is basically a quarter of what you estimate your tax liability to be.
I do
And that's
it
going
real
to save
simple.
and that'll save you on paying penalties. But I
I
would
do it
say
real
this,
simple.
your
Take
first
20%.
year, if you're extending and stuff, just keep in mind you probably don't have to worry so much if you're talking to your accountant and say, it's my first year, I probably didn't make any money this year. If it's for planning purpose, because a lot of times people don't file their taxes on April 15th. They extend if they have businesses, and they file later. Because a lot of times the expenses and things they need to gather are arriving. sometimes your 1099s are not due until April 15th. A partnership tax return is not due until April 15th. So that means, there's no way you're going to get your 1099, which shows how much your portion of that interest is, or a portion of that income is from the partnership you're involved in. So complex tax returns are almost always extended, which means that on April 15th, you're going to make a payment for what you expect the remaining amount you owe, and then you're going to file an extension until October 15th of the same year. So you have 6 months, whatever, April, May, June, July, August, September. You have 6 months in order to get your return completed then.
So what I do for estimated taxes, I make it simple, because Jeff likes simplicity in his life. Every commission that I get from the company, I take 20%, and I put it in a savings account, and then quarterly, I take that amount and send it to the IRS. And I always get money back.
Because you're responsible and you have the money to do it.
Well, everybody has the money to do it. They get a commission check. They have it. Take 20% off, and that's your taxes.
Because you have money.
Well, if you get a check, you have money.
It's
just like if you're employed.
Because you have money in the bank, don't you? You have
No,
savings.
it doesn't matter. Because if you were employed at McDonald's, they take money out for your taxes. So what you're doing is you're taking money out for your taxes.
Yeah.
Because you still have to owe. So take 20%.
And so then all you do is like log on to IRS website and pay them?
Basically,
What?
how do you pay?
So you make estimated tax payments.
No, mechanically, how do you do it? You go to irs.com
Mm-hmm.
and
.gov.
I-O, and then it'll walk you
okay,
through it.
okay.
It's very simple.
It's not
Before the
hard.
taxes. And trust me, the next day they take it out of your account like that.
If you're filing your tax return and you're using a system like
Yeah.
this, and if you've done it before April 15th, it will produce the 4 estimated tax payments for you.
Trust me,
It'll give you the form.
it's simple to give the IRS money.
Money.
They
Yeah.
love
They love
it. Yeah,
They do want your money.
yeah, they make it easy to take your money.
Yeah.
But if you just simply do 20% of every check you get, save it, and then quarterly pay
Maybe
it,
more than enough.
you'll get money back.
Yeah.
So there's a new thing, sort of relatively new, which is now there's another deduction for you, and it has to do with it's just a general business deduction, and you're going to be able to write off a percentage of your profits, your net profits, from real estate.
Really?
Yeah.
Is this starting this year or something?
No, it's been around.
One more time?
Well, it's same with rentals. You didn't know that, did you?
No, well,
Not because you're not a CPA, are you?
Oh, no. I knew this was going to turn this way.
I'm sorry.
I deserve that.
It's a what?
Okay, explain, please.
No, let's just go. And we're getting looped into something that's not
Complicated investment.
We're getting looped into unproductive stuff.
Okay, we'll talk questions. We're not doing 1031 exchange stuff. We're not.
Yeah,
Please
we
don't
do.
do that. We're getting close on our time.
There's so much stuff.
There is.
Anytime you want, you can pop into my office and ask a basic question. I'm not here to do its tax returns, but I can answer most of the questions
Yeah.
for you. Glad to do it. For your clients, to me, the most important, it's very important for them to realize that there's some tax benefits associated with buying a home if they're using it as a rental.
Yes.
And the same if they take their existing home and they're wanting to sell it and buy another home, another consideration is to convert it into a rental property instead of
Yes.
selling it. And I strongly recommend looking at that and shifting that, and that's with a 1031, and shifting that property into something that would be a better rental property.
Well,
So let's say
yeah.
you said, wow, I like my home. I like my $1 million home here, but it ain't going to be much of a rental from music. But if I do a 1031 transaction and I convert and I sell that property, and then the profit converted into 5 $200,000 homes, I can do that and basically take that sale of that $1 million home and not recognize any profit on it, because I'm going to push whatever profit I had that up into the basis of the of these 5 homes that I got from it. That's the 1031 transaction, and that's the benefit you can
And
get
if
from
you've
doing it.
lived in it for 2 of the past 5 years, what else can they do, Dad?
Well, you're talking about the general deduction that has to do with anyone wanting to write off when you sell your home.
Yeah.
And they can write off a couple can write off at least the last up to $500,000. Has it changed the number?
I think it's gone up a little bit.
The last
I think
I
it's
saw,
750.
yeah, well, I use it.
Well, whatever, yeah.
I use the form. I use my computer. It tells me every time I look.
But,
So
yeah.
it's gonna, yeah, that's right.
There are, okay, so when you get it, okay, let me make a big point on this. As Dad's saying, he's completely right, but when your clients are looking to get into investment properties, I really recommend they sit down with a CPA
Yes.
and consult,
Yes.
like come up with a strategy. Cause
Or if they're
there's a
looking
lot-
if they're selling their rental
Yeah,
property.
selling, renting,
Yeah.
Well-
dealing with depreciation and such with that is huge. And interest, write-offs,
Well,
everything.
If you're gonna do the 1031, it's very
Well,
complicated.
1031, yeah, that's a whole other thing in itself. Let's not please don't do 1031.
But you should all be aware that there are some benefits to owning a home when
Yeah.
people are buying a home. One of the questions you're asked, do I have any tax benefits?
Yes.
And they might. But you need to understand, most people really don't. Because their benefit is going to come on most people, it's going to be the standard deduction that's sitting on their tax return that they're
Well,
going
the interest, yeah, and all that, yeah.
I say
Yeah,
that.
the thing,
Well, it's very important to understand. Because people think, oh wait, why are my taxes not better? Why am I paying just as much as I did before? I just bought this house. Because they only had, let's say, $12,000 of standard deduction before,
Yeah.
and now they have 20,000 of standard deduction, and they haven't passed the limit anyway, and so there's no benefit because they took the standard deduction in the first place. And with all the benefits of buying that home and turning it into rental, or even for themselves and writing off the interest in taxes, the interest in taxes go to the same place on the tax return. It's Schedule A, the same place.
You know what's got hurt a lot because of that? Charity. 'Cause you can't write off really charity.
Well,
You just take deduction.
it's a shame. It really is a shame because the end result is
Charity should be above the line.
that almost everyone takes the standard
Standard
deduction
deduction.
now. And so, you can't really tell your clients you're going to save money on your because of the interest in taxes on your taxes because they probably are already saving it with the standard deduction.
That happened about 8 years ago.
So don't ever provide tax advice. If you're going to say something like that, their real benefits would be if they buy a rental home.
Well, okay, okay.
Anything.
It's
anything
not
you
interest
lost-
and write-offs that are really good about owning a home. It's you're going to be living somewhere anyways,
taxes.
and you're not going to have to pay capital gains
I get
on it when you sell. That's huge. That's like
I'm not-
free. The closest thing you're going to get to free money is being able to sell your own residence, move somewhere else, and not pay capital gains. If it's up to $700K, good luck.
In Texas.
Yeah, very good luck. Yeah,
In Texas. Don't do it in New York.
Yeah, in other states, obviously, your property value is $3
So
million.
Brad, I don't get paid
Yeah.
commissions anymore. I get paid tips.
Oh God, don't do this to me. Let's
I have to
not.
make this not boring. Come on.
Okay, that's
Jeff, you're
thank
a
you.
bad
Okay, after
Wait,
this
time
video.
out. Oh, Carla had a question. Carla had a question. Go ahead.
Commissions from rentals count?
That's income.
Yeah, that's income.
Okay.
Oh yeah.
Another one.
It'll
Give it to you every year.
all be on your 1099 that you're going to get.
All right, the next video is going to be on just tax tips.
Oh God.
And by the way, don't stop recording. Rentals are a great way to start your business.
Yes, they are.
We've talked about that. Yeah.
Cool. All right.
My wife did that.
See y'all next week. Brad will talk all about the convention.
Yep.